Hey everybody. So today I wanted to talk to you about inventory cost flow assumptions. And this can be a little bit confusing because I think before you take an accounting class, you're thinking, well, you just don't think about inventory cost flow assumptions because why would you? But if you did think about it, you'd probably think, well, you just, you when you buy some inventory, you add it to your inventory, and then when you sell it, you take it out of your inventory. It's that easy. The problem is that oftentimes we purchase inventory in multiple lots or multiple groups of inventory, and the cost isn't always the same, meaning prices fluctuate up and down. So we could have the exact same item sitting on our shelves or in our storage, um, and that some units of that item cost more or less than other units. So the question is, when I sell those units, well, what is my cost of goods sold? Which units am I selling? If the units are identical, it's impossible to tell. And also, then when I want to calculate what my remaining inventory is for my balance sheet, which units are still sitting here? And so it can be a little confusing. So what accountants have come up with are inventory cost flow assumptions. In other words, we choose one of four different methods. Typically, there's others, but these are the four biggies. We choose one of four different methods for for I guess assuming or maybe estimating would be a better word, which units we have sold and which units we still have in our inventory. So on the screen, you can see an exhibit that shows three of those methods. And then the fourth method is called specific identification, which I'll talk about in a minute. So the three types I have on the screen here are first in, first out. When we do first in, first out assumptions, we assume that the first units we buy, that we purchase into inventory, we assume that when we make a sale, that we're going to sell the oldest or first units purchased um, first. So we just assume the oldest units are always the ones we're selling. First in, first purchased by us, first out are the first ones sold. The second assumption is called last in, first out, where instead we assume the most recently purchased units are the first ones we're selling. This seems a little strange, but for some businesses, it's a good model. And then third is what's called a weighted average. Rather than trying to guess which are in and which are out, we just find our average cost and then use that cost as our cost of goods sold, and also as the cost of the remaining items in inventory. Um, so like I said, there's one more. Whoops. Maybe. All right. So here's our information. We're going to just kind of walk through an example of each type. Um, so here's a business. They sell mountain bikes. And you can see they had a beginning inventory on August 1st of 10 units that they acquired at a cost of $91 per unit, for a total cost of $910. Then on August 3rd, they purchased 15 more units. On August 14th, and you can see that those ones on August 3rd were purchased at a higher price, $106 per unit. Then on August 14th, they sold 20 units for $130 to the customer. That's not much of a markup. They're not making too much money, but I guess that's beside the point. Then on August 17th, they purchased 20 units at 115. August 28th, they purchased 10 more units at 119. And then they sold on August 30th, 23 units at $150. So the other columns show you, or the totals, we can see that they had 55 total units available for sale during the period. So the 10 they had at the beginning, plus the 15, 20, and 10 that they purchased throughout the month. And then the next column, the $5,990, tells you the cost of the goods that were available for sale. Then we can see the total number of units we sold. And finally, we can see the number of units in ending inventory. So the question we would have here is, okay, at the end of the month, we want to calculate our cost of goods sold and the value of our remaining inventory. The question is, well, which units did we sell? Which 43 units? And which 12 units do we still have? Because the units didn't all cost the same. Okay, so that's why we need these inventory assumptions to figure out or to estimate which units we sold and which units are still remaining. So the first type is called the specific identification method. This is often used by businesses that have a small amount of inventory that is high cost. So like auto dealerships is a good example. And inventory that is readily identifiable, right? Each car has a unique vehicle identification number. So they can tell you exactly which car they sold. They know exactly how much it cost them. And so, I mean, if you think about it, this would be the best method if it's possible, but it probably isn't possible for a business like Walmart to track each can of peas that they sell individually, right? But for a car dealership and maybe for our bike store here that only sold, what was it, 40 some odd units in a month or 50, yeah, I think it was 40 something. It would be easy. So with specific identification method, all you do is you know which units you sold. And so you can see in the cost of goods sold calculation, they know that they sold 8 that had a cost of 91 on August 14th and 12 that had a cost of 106 on August 14th for a total of $2,000. And then on August 30th, they know they sold 2 that had a cost of 91. So in a problem, you can imagine they're going to have to give you this information, right? If you're doing specific identification, they're going to have to tell you how much the units that you sold cost. And so there's the whole, that's how you do specific identification. You just multiply the number of units sold times the cost, and that gives you a total cost. And then you can always find your ending inventory by just taking the cost of units available for sale minus the cost of goods sold will tell you the cost of the units still remaining in inventory at the end of the period. So the second is called first in, first out. So the first in, first out, we're going to assume the oldest units are the first ones we sell. Okay. Now, this won't necessarily match up with the truth. Like we may not sell the oldest units. It's just an assumption, for estimating purposes. So we don't worry too much about that if we have products where we can't tell what there's, which specific one we sold. We just are going to make this estimate. So what we do is we start with our goods that we had at the beginning, 10 units that cost $91, then our purchase. And so we see after we purchase 15, we now have 10 at 91, meaning 10 that cost 91 and 15 at 106. So when we get to our first sale on August 14th, the question we're asking again is, well, which units am I selling? And so the answer is the oldest units. So we're going to sell all 10 of the older units, the ones that cost $91 first, before we assume we sold any of the newer units that cost 106. So they sold 20 total units on August 14th. So they're going to say they sold all 10 of the $91 units and 10 of the $106 units for a cost of $1,970. The remaining inventory then would be 5 units that had a cost of 106 for a total of 530. On August 17th, they purchased 20 more at 115. So now you can see our inventory balance, 5 at 106, 20 at 115. Then on August 28th, they purchased 10 more at 119. So we just add that into inventory. We have 5 at 106, 20 at 115, and 10 at 119. And then on August 30th, we make another sale and we sell 24 bikes, or 23 it looks like. And so again, our question is, well, which bikes am I selling? And the answer is the oldest ones first. So I'm going to assume I sold all 5 of the $106 units. And then the remaining 18 bikes I sold, I'm going to assume are all the $115 units. So 5 at 106 and 18 at 115 gives us 2,600. And the bikes still in inventory then will be 2 of the $115 units because we had 20, sold 18, and 10 of the $119 units. And then at the end of the period, we can say, okay, my total cost of goods sold was 4,570, and my remaining inventory balance is 1,420. So that is first in, first out, just using the assumption that the first units purchased are the first units sold. So with last in, first out, we're going to assume the opposite, okay? That the last or most recently purchased units are the ones we sell. So the same process we have until we get to a sale, okay? So for purchases, we're just going to keep sort of listing them in order of their purchase date. So we start with $10 at 91, our beginning balance. Then we purchase 15 more at 106. And then we get to August 14th and we make a sale. We sell 20 bikes. So the question is, well, which bikes did we sell? So with last in, first out, we're going to assume it's these last units, the ones we purchased most recently. So I'm going to assume I sold all 15 of the $106 units, plus 5 of the $91 units to sell my total of 20. That means remaining in inventory is still 5 of the $91 units. So a lot of people get confused by this because they're like, why would you do this? Why would you assume last in, first out? And the answer is that some businesses have a model where they're selling their newest product more readily than they're selling their older product. Technology businesses are a good example. If you go to the Verizon store and you look at the iPhones there, they're going to be selling more of the newest iPhone than they're going to be selling of older iPhones. And so even though this isn't a perfect assumption, again, sometimes people will buy the older ones or something like that. It just more closely matches their model of how they do business. And so for some businesses, it makes sense to assume the last in is the first out. So then we have August 17th, where we purchased 20 at 115. So our inventory at that point is 5 at 91 and 20 at 115. August 28th, we purchased 10 at 119. So we now have 5 at 91, 20 at 115, and 10 at 119. And then on August 30th, we make a sale of 23 units. And again, the question, which units are we selling? And again, it's the last in, or the most recently purchased. So we're going to assume we sold all 10 of the $119 units, plus 13 of the $150 or $115 units. So our total cost there is 10 at 119 and 13 at 115. And then what's left in inventory? Well, it's still 7 of the $115 units and 5 of the $91 units. So using this method, we would have a cost of goods sold at the end of the year of 4,700, or sorry, the end of the month, 4,730, and an inventory balance of 1,260. So what's interesting about these two is we sold the exact same number of bikes, but because of the inventory cost assumption we used, we end up with a different cost of goods sold number. And so these assumptions matter. They impact our taxes. And so the IRS wants us to be consistent in the one they use. We're allowed to choose the one we want, but we have to be consistent in what we use. And they have impacts on our balance sheet because the value of that remaining inventory is different using the two different methods. Again, businesses are free to choose which one they feel best fits their needs, as long as they're consistent in that. All right, so the last one, the last type of assumption is called a weighted average assumption. So this one says it's hard for us to know if we should do first in, first out, or last in, first out. So instead, we're going to do an average, which will be somewhere in the middle of those two, as averages often are. This will seem more complex, but it's not as bad as it seems. So with the weighted average method, what we do is each time we make a purchase, we recalculate our average cost per unit. So in our example we had before, we had a beginning balance of 10 units that cost us $91 for a total of $910. And And then on August 3rd, we purchased 15 more units at 106. So what we do to find the average is we just add up the cost. So we had we had $910 worth of units, and then we purchased another $1,590 worth of units. So for a total cost of $2,500. And then all we do is divide that by the number of units we have in inventory. So 2,500 divided by 25 gives us an average cost of $100 per unit. What this does is it gives us that average cost that we can then use when we actually sell a unit to estimate our cost of goods sold. So on August 14th, when we sell bikes, we will use the average cost as of that date to calculate our cost of goods sold. So if our average is 100 and we sold 20 bikes, we'll say 20 times 100 is $2,000. And we'll have our average cost of 5 at 100, or $500 remaining in our inventory balance. Then when we purchase more bikes, we can recalculate our weighted average. So now our average, August 17th, we had 5 at 100. We bought 20 more at 115. So we'll take the cost of those bikes, 500 plus 2,300 gives us $2,800, divided by the total number of bikes we now have in inventory after the purchase, which is 25, and our new weighted average cost is $112 per unit. Then we have another purchase on August 28th, 10 more units. So we'll take our 25 units at an average cost of $112, and we just purchased another 10 units at a cost of $119. So 2,800 plus 1,190. Our cost of our goods that are available for sale is 3,990. We divide it by the number of units we have on hand, which would be the 25 that we had before, plus the 10 more we purchased, or 35. And that gives us a weighted average cost of $114 per unit. So each time we make a purchase, we recalculate our average cost. And then when we make a sale, we use that average cost both for calculating the cost of goods sold and for calculating the cost of the remaining inventory. So on August 30th, when we sell 23 bikes, we do 23 times our average cost per unit at that time of that sale. So 23 times 114 is 2,622. And the remaining inventory of 12 units times 114 gives us 1,368 as our balance at the end of the month. Then at the end of the month, we can look at our cost of goods sold for the month, and we can look at our inventory balance at the end of the month. If we were to compare the three methods, first in, first out, last in, first out, and weighted average, we would see that weighted average always comes out in the middle of those two if we have a period of rising or dropping costs, okay? Anyway, so that is the four methods that we use for inventory cost assumptions. The first method isn't really an assumption when we do specific identification because we know the actual amounts, so there's no assumption involved. But the other three, first in, first out, last in, first out, and weighted average, all are assumptions to help us to come up with the answer of, well, what was the cost of the items we sold? And what is the cost of the items we still have in inventory? I hope that helps clarify it. And I think I might try to put together an example video where I work through a problem as well. So good luck. And as always, don't be afraid to reach out if you need additional help.